The only thing to fear is fear itself. In the modern economy, it is often the reactions to the fear that cause the real damage rather than the event in question. The neo-Malthusians and apocalyptic fantasists are back in force this year, spreading the never-ending message of fear, doom and gloom. There's a fundamental epistemological fallacy in this view of the world. Resources are not scarce, they're abundant. Energy supply is not constrained, it is vast. Human will and ingenuity is not limited, it is infinite. It is in this world of never-ending growth that we live, and hence, we believe and invest in the future that will be unimaginably richer in all its forms than the present. We see Asia ex-Japan being the fastest growing large region in the world over the next few decades, as the fusion of a rising Asian middle class meets the rapid adoption of new technologies. By 2030, we expect Asia ex-Japan to support the world's largest regional economy, the world's largest consumer market, and the world's largest financial market. Within this region, we are looking for what we believe are the best long-term growth companies, and we aim to hold them for long enough to earn outside rewards. We call this growth squared. We continue to look for companies that can at least double either earnings or revenue on a 5-year time frame. We aim to run our winners and quickly and decisively sell our losers. The ongoing global pandemic has increased the uncertainty that was already prevalent before this crisis. Disruption from new technologies, political schisms, trade wars, culture shocks. None of these factors have gone away, and in some cases, like technological adoption, the pandemic has accelerated these changes. Asia ex-Japan has managed the COVID crisis relatively well, and China, despite being the epicenter of the viral outbreak, seems to be leading the world in terms of both the economic rebound and removing COVID-related restrictions. For equity investors, we believe that Asia ex-Japan remains highly attractive as a destination for capital in both the short and the longer term. With the rise of a domestic investor leading the charge in their asset markets, we would not be surprised if Asia ended up as a favored asset class by the end of the decade. We believe it is a great time to be a business owner. When the economy recovers, and it will recover, we will find that those businesses that survive this crisis will have less competition and a better cost structure than prior to the crisis. For many companies, revenue and margins will surprise on the upside as the recovery gathers pace. Firstly, we continue to love the technology companies that have demonstrated how vital they are to the workings of the global economy in this pandemic. We believe that many of these businesses will only get stronger. Secondly, we are looking for companies where the competitive dynamics are likely to produce a much more favorable revenue and margin upside in the next 5 years compared with the last 5. In terms of the current portfolio, around 65% of our holdings are in 4 countries: China, Korea, Taiwan and Vietnam. Sector-wise, technology, consumer discretionary and communication services are our largest weights. Although over 30% of the fund is invested in large cap companies over $25 billion, we have a very long tail of potentially hyper-growth companies represented by us having 30% of our assets in sub-$2 billion companies. In terms of our top 10 holdings, 4 are related to e-commerce in region, such as Sea, Alibaba and JD.com. 2 are related to online gaming. Then we have exposure to a rapidly growing software market in China via Kingdee, the global EV and battery market via Samsung SDI, and a rapidly rising Chinese footwear brand, Li-Ning. LNC Bio is a small-cap Korean biotech company that has recently entered the top 10 on account of its stellar share price performance over the year. It is good to see our patience paying dividends, with the majority of our top 10 attribution stocks held for many years. In late 2017, I flew to Indonesia to meet with the founder and senior management of Sea Limited, the e-commerce and gaming company we had recently taken a stake in. There I met one of the local mum-and-pop retailers who had just seen their sales go up tenfold after they moved onto Shopee's e-commerce platform. At the time, the market cap was around $5 billion. I had a blue sky scenario of a $50 billion market cap in 3 to 5 years. Today, at $75 billion, it is the largest listed company in the ASEAN markets. We believe the best days for the company are still ahead of it. We have also been recycling some of our gains into new ideas. For example, on the back of the success of Li Ning, a turnaround story of Chinese leading footwear brand, we began looking for other Chinese consumer brands which could benefit from a rise in tastes away from global brands towards domestic brands. Ningbo Peacebird is a small fast fashion brand listed in the Asian market in China. It operates in a deeply fragmented industry undergoing consolidation. We see the possibility of a brand led by an entrepreneurial management team and leading fashion designers to potentially replicate Li Ning's success in this more competitive market. Elsewhere, for example, we have bought Tata Motors, the owner of Jaguar Land Rover, a company with a checkered past, but one where we see significant upsides from a small turnaround in the top line can lead to a very significant rise in the bottom line for this business. Lastly, we acquired Huya, China's leading gaming live broadcasting platform, now majority owned by Tencent. We see a potential merging of the online playing and live watching of games to create a whole new genre of immersive digital entertainment, which Huya may lead. It is unlikely that the global uncertainties will abate in the medium term. However, we have a truly active Asian portfolio of interesting growth ideas, and we believe this is an ideal backdrop to invest in growth companies for the long term in Asia, ex-Japan.